The layoff numbers are rising again. Not quietly, not gradually, but in sudden, concentrated waves. Google, Meta, Amazon, Apple, Microsoft, all reporting strong profits, yet simultaneously announcing new rounds of job cuts. On paper, this makes no sense. If companies are making money, why are they letting thousands of people go? So today, we're going deeper than the headlines. Because the reasons you hear in the news are not the real story. What's actually happening inside the tech sector is something far more structural, far more long-term, and far more concerning. This is the hidden reason tech layoffs are surging again. At first glance, the current wave of tech layoffs feels contradictory. Across Silicon Valley, companies are reporting strong earnings, steady cloud revenue, and continued demand for AI services. Stock prices remain elevated. Profit margins are healthy. Nothing in the financial statements suggests distress. And yet thousands of workers are being cut, teams dissolved, and entire departments quietly shut down. Executives publicly frame these decisions with familiar language. Efficiency improvements, rebalancing priorities, strategic restructuring, or correcting pandemic overhiring. These statements are true on the surface, but they don't explain why the cuts are accelerating now, or why companies with billions in free cash flow feel compelled to shrink their workforce. Because when we zoom out, a different pattern emerges. The layoffs are not isolated events or responses to short-term fluctuations. They are coordinated signs of a deeper transition, one that suggests the tech sector is no longer operating under the assumptions that defined the last decade. Something fundamental has shifted beneath the surface, and the sudden rise in layoffs is merely the first visible symptom. One of the hidden forces driving today's layoffs is the quiet end of the tech industry's hypergrowth era. For nearly 2 decades, Silicon Valley expanded under a single assumption that digital demand would rise endlessly. Every year brought more users entering the online ecosystem, more devices being purchased, more businesses migrating to cloud services, and more advertising dollars flowing into platforms. Growth wasn't just expected, it was built into the business model of every major tech company. But now, many of those growth engines are slowing at the same time. Smartphone adoption has reached saturation across developed markets. Hardware upgrades occur less frequently as improvements become incremental rather than transformative. PC and tablet sales, once boosted by remote work, have fallen back to pre-pandemic trends. Even cloud computing, one of the strongest pillars of tech, has seen year-over-year growth cool from explosive double digits to more mature, moderated levels. On the consumer side, digital advertising is no longer expanding at the pace it once did. There are only so many ads a finite population can be shown. And on the enterprise side, software budgets are tightening as companies confront higher interest rates and uncertain macro conditions. This shift from rapid expansion to structural maturation changes everything. When growth slows, tech companies can no longer rely on scale and headcount to drive performance. They must pivot from grow first to optimize first, redesigning operations around efficiency rather than expansion. Today's layoffs are not simply corrections of pandemic overhiring, they are the industry's early response to a new reality, a future where growth is no longer guaranteed. Another major force behind the surge in tech layoffs comes from outside the companies themselves. A dramatic shift in the financial environment that has fundamentally rewritten how the industry operates. For more than a decade, the tech sector enjoyed the benefits of near-zero interest rates and abundant liquidity. Capital was cheap, investor expectations were generous, and companies were rewarded for pursuing aggressive expansion, long-term bets, and experimental projects that might take years to generate meaningful returns. In that world, hiring aggressively wasn't risky, it was the norm. But when interest rates rose at the fastest pace in modern history, the entire foundation of that model cracked. Higher rates do not just increase borrowing costs, they fundamentally alter how investors value future growth. A dollar earned 10 years from now is suddenly worth far less, pushing companies to prioritize immediate profitability over distant potential. Boards and shareholders now demand leaner spending, stricter cost controls, and clearer paths to margin improvement. This shift reshapes executive incentives. Projects that once looked promising now appear too uncertain. Middle layers of management become harder to justify. Teams built for rapid expansion are suddenly oversized in a world expecting slower growth. Even divisions that generate revenue may face cuts if they are no longer strategic or if their return on investment falls below new thresholds. So when profitable companies announce layoffs, it's not because they are struggling today. It's because the financial era that supported expansive headcount and long growth runways has ended. The tech industry is being forced to operate under a new set of rules where efficiency, not ambition, determines survival. A third and far more disruptive force behind the new wave of layoffs is the rapid rise of AI and the extraordinary cost structure that comes with it. While the public conversation frames AI as a breakthrough that will generate new opportunities, inside the companies themselves, AI has created a new financial reality. It is consuming budgets at an unprecedented scale. Training modern AI models requires billions of dollars in compute infrastructure. Even after training, maintaining and deploying these systems demands continuous GPU capacity, massive energy consumption, and specialized engineering talent with compensation packages far above typical industry levels. Every major tech company is now locked in an arms race for AI dominance, and this race is extraordinarily expensive. The result is a zero-sum trade-off. Every dollar allocated to AI must be taken from somewhere else. And the easiest place to extract that funding is headcount. Teams that once handled manual coding, quality assurance, content moderation, customer support, and internal operations now face pressure because AI tools can automate or streamline much of their work. Entire layers of middle management become redundant in AI-driven workflows. So, these layoffs are not temporary corrections. They are the early stages of a deep structural shift, one where human labor is gradually replaced by algorithmic systems and where the future of growth comes from compute, not people. When we combine slowing growth, tighter capital conditions, and the enormous financial demands of AI, a clear pattern emerges. Tech companies are not simply shrinking, they are rebuilding themselves from the inside out. The layoffs we're seeing now are not random cuts. They reflect a deliberate restructuring of how these companies intend to operate in the next decade. The old expansion-era organizational model, large teams, overlapping roles, broad product portfolios, and sprawling middle management, is being replaced with something leaner, more centralized, and far more automated. Companies are systematically shutting down experimental projects that no longer justify their cost. They are consolidating engineering teams, merging duplicate functions, and reducing layers of supervision that slow execution. Functions like support, trust and safety, operations, and testing, once major employers, are increasingly augmented or replaced by AI systems that operate more cheaply and at greater scale. Even profitable divisions are being trimmed if they don't align with long-term strategy. This is a key point. Today's tech layoffs are not about immediate profit margins, they're about reshaping the company around future priorities. And those priorities are becoming clearer. AI, cloud infrastructure, core hardware, and mission-critical software ecosystems. Everything else is negotiable. What emerges is a smaller, more specialized workforce, one designed for an industry where growth depends less on headcount and more on compute power, automation, and capital efficiency. The irony is striking. The stronger a company is today, the more aggressively it restructures for tomorrow. Because in a world defined by AI-driven competition and slower macroeconomic expansion, the cost of carrying excess weight has become too high to ignore. So when we step back and look at the bigger picture, the surge in tech layoffs is not a mystery at all. It is the outward expression of a deeper transformation, a shift from an industry built on endless expansion to one forced to confront structural limits, rising capital costs, and the overwhelming financial demands of AI. These companies are not reacting to short-term shocks. They are repositioning themselves for a future where growth is slower, competition is more intense, and automation replaces entire categories of work. The layoffs are not the crisis. They are the signal, a warning that the economic engine of the last decade is under pressure. And the most important question is this: if the most profitable companies in the world feel compelled to cut thousands of jobs, what does that say about the stability of the system they operate in? Because this is not just about headcount, it's about what comes next. In our next video, we go one level deeper into this shift and unpack an idea that sounds impossible on the surface, yet is becoming the new normal in Silicon Valley. Why tech giants are cutting jobs even while profitable. If today's layoffs are the early tremors, the next chapter reveals the fault lines underneath and what they tell us about the future of the global economy.